Two people each have $50,000 sitting in cash. Same amount, same purpose. Emergency fund, down payment, just liquid money they don't want to risk. The first one keeps it in a regular checking account at one of the big national banks. Over a year, she earns about $50 in interest, basically nothing. The second one moves the same $50,000 into the right combination of accounts, doesn't change anything else about how she lives, and earns about $2,500 over the same 12 months. Same cash. Same risk profile. A $2,450 difference every year forever for about 30 minutes of setup. By the end of this video, you'll know exactly which accounts to use, how much to keep in each, and the tax trick most people miss. But first, why the money sitting in your checking account right now is quietly losing value every single day. The average checking account in America pays a yield of about 0.4% a year. Some pay zero. None pay enough to keep up with inflation, which has averaged around 3% annually over the long run. The math here is simple and brutal. $1 sitting in checking for a year actually loses about 2.5% of its purchasing power. Stretch that over 10 years on serious savings and you've quietly given up real wealth. Banks count on you not noticing. They make money on the spread between what they pay you and what they charge other people to borrow your money. Letting cash sit in checking is essentially making a zero-interest loan to a bank that's loaning the same money out at 6 or 7%. The good news is, you don't have to do anything dramatic to stop this. You just need to know the 4 real options for cash that actually pay. There are exactly 4 account types worth knowing for serious cash. 1. High-yield savings accounts, usually called HYSAs. 2. Certificates of deposit, or CDs. 3. Treasury bills, often called T-bills. 4. Money market funds. Each one pays meaningfully more than a checking account, each one is essentially safe in different ways, and each one is the right tool for a different job. The mistake most people make is pretending they're interchangeable. They're not. Pick the wrong one for the job and you're either leaving money on the table or you're locked out of your own cash when you need it. Let's go through each one in plain English and then we will assemble the actual strategy. A high-yield savings account is the simplest upgrade you can make to your financial life. It works exactly like a regular savings account, but because it's offered by an online bank instead of a brick-and-mortar bank, the overhead is lower and they pass that savings on to you as interest. Right now, the best HYSAs pay somewhere around 4 to 5% annually. The money is FDIC insured up to $250,000 per bank. You can pull it out the same day or next day in most cases. There's no commitment, no penalty. Just better interest, paid every month, automatically. If you have any meaningful amount of cash in a regular checking or savings account at a national bank, moving it to an HYSA is the single highest return on effort move in personal finance. It takes about 15 minutes to open an account. Once it's open, the interest compounds quietly forever. A certificate of deposit is a deal you make with the bank. You agree to leave your money untouched for a fixed period of time, 3 months, 6 months, a year, 5 years, and in exchange the bank pays you a guaranteed interest rate locked in for the full term. The advantage is, the rate is locked. If interest rates fall in the next year, your CD keeps paying the higher rate you signed up for. The disadvantage is your money is locked too. Pull it out early and you usually owe a penalty of several months of interest. CDs make sense for one specific situation. You have cash you definitely will not need until a known future date. Saving for a down payment in 18 months? A CD that matures the same week is a quiet, perfect tool. For genuine emergency money, CDs are wrong. You can't get to it when you need it. For purpose, specific saving with a deadline, they often beat HYSAs. Treasury bills are short-term loans you make directly to the US government, for terms ranging from 4 weeks to 1 year. They typically pay rates very close to HYSAs, sometimes slightly higher. And here's the quiet advantage almost nobody mentions. The interest from T-bills is exempt from state and local income tax. If you live in a state with high income taxes, California, New York, New Jersey, Oregon, that state tax exemption can be worth an extra 0.5% to a full percentage point in your pocket compared to an HYSA paying the same nominal rate. You can buy T-bills directly through Treasury Direct or inside any brokerage account. They're as safe as any investment in the world because they're guaranteed by the US government. For state tax-sensitive savers, T-bills quietly beat HYSAs after taxes are factored in. A money market fund is a type of mutual fund that invests in very short-term, very safe debt instruments, including a lot of T-bills. Functionally, from your point of view, it works like a savings account inside a brokerage. It pays interest, usually close to the same rate as an HYS, sometimes slightly higher. It's accessible, you can pull from it same day in most cases. The advantage over an HYSA is that it lives inside your brokerage account, so you can move money instantly between investing and cash without external transfers. The disadvantage is it's technically not FDIC insured the way an HYSA is. Money market funds have an extremely strong safety record but are not government guaranteed. For most people who already have a brokerage account, parking some emergency cash in a money market fund inside that brokerage is a clean, frictionless choice. Here's the part that flipped the decision for many savers. Interest income from HYSAs, CDs, and money market funds is fully taxed as ordinary income at both the federal and state level. Interest from T-bills is taxed only at the federal level, state and local tax exempt. So if you live in a state with a 6% income tax, an HYSA paying 4.5% is really paying you about 4.2% after state tax. A T-bill paying the same 4.5 would actually pay you the full 4.5, because the state tax never applies. On serious cash balances, this can be the difference between several hundred and several $1,000s in your pocket annually. Most people never run this math. The savers who do know which account to use depending on which state they live in, and they quietly win the after-tax race. Here's a reasonable framework for how to actually deploy cash. Bucket 1. The spending buffer. 1 to 2 months of expenses in a checking account used for normal monthly cash flow. Bucket 2. The emergency fund. 3 to 6 months of expenses in a high-yield savings account fully liquid for true emergencies. Bucket 3. The planned spending fund. Money you know you'll need at a specific future date for a known purpose. House down payment, taxes, a planned big purchase. CDs or T-bills matching the timeline. Bucket 4. The strategic cash. Money beyond your emergency fund that you want to keep in cash for opportunity or peace of mind. Money market fund inside a brokerage or T-bills where it earns yield but stays accessible. Most people lump all 4 into one account and lose money on 3 of the 4 functions. Here's a strategy serious savers use, sometimes called a CD or T-bill ladder. Instead of putting all your cash in one 12-month CD or one 6-month T-bill, you split it across several maturities that come due one after another. Quarter 1 matures in 3 months, Quarter 2 in 6 months, Quarter 3 in 9 months, and so on. As each piece matures, you either spend it or roll it back into the longest rung of the ladder. The result is, you always have money coming available, you always get the higher rates from locking in longer terms, and you never get trapped with all your cash locked up at the wrong time. It takes about 20 minutes to set up, and it quietly increases your average yield across your entire cash position. 3 mistakes quietly cost the average saver real money. 1. Keeping the emergency fund in regular checking. The opportunity cost on $5,000 in checking versus an HYSA is about $200 to $250 a year, per year, forever. 2. Putting actual emergency money into CDs or long-term T-bills. Sounds smart for the yield until the emergency arrives and you can't get to the money without penalties. 3. Leaving money in a money market account at the same bank as your checking, where the rate is mediocre, instead of moving it to a true HYSA or a brokerage money market fund where rates are competitive. Each of these mistakes individually is small. Stacked across years and the right balance sizes, they quietly add up to 5-figure differences. Here's the practical playbook. Open a high-yield savings account at any top-rated online bank, 15 minutes, no fee, set up an automatic transfer of your emergency fund into it. If you have a brokerage account already, enable the cash sweep into a money market fund. This is often a single toggle. If you have a chunk of cash for a known future date, research current CD and T-bill rates and pick whichever matches the timeline. If you live in a high-tax state and have meaningful cash balances, lean toward T-bills inside a brokerage for the state tax exemption. None of this requires sophistication. It requires 15 minutes once and then automatic compounding from that point forward. Quick reminder, this is general education, not personalized financial advice. Specific account choices depend on your situation. So here's the whole thing in one breath. Cash sitting and checking is quietly losing value every day. 4 real account types, HYSA, CDs, T-bills, money market funds, each solve a different problem and each pay meaningfully more than checking. Match the bucket to the purpose. Factor in state taxes if they matter for you, build a ladder if you have serious cash, and stop letting banks earn the spread on your money. The gap between $50 a year and $2,500 a year on the same $50,000 in cash is one decision, one afternoon, repeated forever. If this helped, subscribe. Thank you for watching, and see you in the next video.